I want to talk to you tonight about something that truly keeps me up, something I see manifesting with alarming regularity in the gold and silver markets. This isn't just about volatility. This is about deliberate, calculated pressure exerted on these crucial assets almost exclusively during periods of low liquidity. I call it the nighttime alert, because for those of us serious about preserving capital through physical metal and the equities tied to them, the most consequential actions are often taken while the traditional Western markets are sound asleep. This isn't a theory. It's a pattern of manipulation that has become predictable, yet increasingly aggressive, and understanding this mechanism is absolutely vital to protecting your portfolio from unnecessary attrition. We've watched this dangerous dance for decades, this relentless war waged by the paper market against the physical reality of gold and silver scarcity. But the intensity and, crucially, the timing of the manipulation are evolving. When I speak of the nighttime alert, I'm explicitly referring to those sudden, highly coordinated barrages of selling, massive short positions dumped into the futures market that smash the nominal price of gold and silver when the U.S. markets are closed. Specifically, we are often talking about that crucial window between late afternoon in New York and the early hours of the following morning, primarily coinciding with the start of Asian trading sessions or late London activity. The goal is clear: maximize downward pressure when liquidity is thinnest, thus ensuring maximum damage to the price chart with the least amount of effort, effectively shaking out weak hands and frustrating long-term investors before the sun even rises on the COMEX floor. Let's ground this in the current macroeconomic reality, because without context, these price attacks seem random. Look around. Inflation is rampant. Not just the 2% fantasy the central banks peddle, but genuine, sustained commodity and housing inflation that is decimating purchasing power globally. Debt levels are astronomical. We are now operating in a fiscal environment that requires continuous money printing merely to service the existing obligations, let alone finance new spending. In a sane, honest world, one governed by sound monetary principles, gold and silver should not just be rallying. They should be parabolic, reflecting the monumental systemic risk embedded in fiat currencies. Yet we see these persistent, irritating, and frankly suspicious dips. Why? Because the nominal price of gold and silver must be suppressed to maintain the illusion of stability and confidence in the very fiat system that is fundamentally unsound. This manufactured suppression is the stage upon which our nighttime alert plays out. The conflict we face is profoundly simple: paper versus physical. We, the investors seeking protection, are fighting against a colossal architecture of derivatives. Futures contracts traded predominantly on the COMEX, often leveraged 50, 70, sometimes even 100 to 1. These paper instruments, which represent only a promise of delivery, are constantly used to overwhelm the actual available supply of physical metal. This derivatives market is the primary weapon employed by the large bullion banks and their proxies to enforce an artificial price ceiling. And as I mentioned, the timing of these key attacks is not accidental. They happen consistently between 10 p.m. and 3 a.m. Eastern Time, often in the dead of night, where the depth of the order book is shallowest, allowing a relatively small input of paper shorts to trigger massive cascading stop losses and algorithmic selling. The core vulnerability in this entire structure, the open loop that keeps me focused, isn't if this paper structure will eventually fail, but when the physical market decides it has simply had enough. We need to focus on what happens the moment real tangible supply exhaustion hits the surface, where the paper players cannot meet genuine demand for physical delivery. I believe that moment of truth is much closer than most mainstream analysts, who only look at technical charts during regular hours, are willing to admit. We need to analyze the data with forensic precision. Look at the verifiable physical demand. India and China, the great accumulators, are vacuuming up physical metal at a pace that far exceeds what their reported imports suggest. Central banks globally, having experienced the fear of the 2008 crisis and the post-2020 geopolitical shockwaves, have resumed their aggressive, consistent buying spree, often repatriating gold from Western vaults. This massive, sustained, and verified physical demand is completely decoupled from the sluggish, often backward-moving price action we see on the screen. This disconnect is mathematically and economically unsustainable over the long term. Let me take a moment here to emphasize the critical nature of this analysis. If you are finding this discussion valuable, if the clarity of this structural manipulation resonates with your own observations of the market, please take a moment right now. Hit that like button and, importantly, subscribe to this channel. We need to push this message, this reality, to as many investors as possible who are currently being misled by the mainstream financial media. Your action helps counteract the institutional noise. Back to the tactics of the nighttime alert. We must consider the sheer size of the short positions often placed during these nocturnal hours. These moves are not organic. They are usually concentrated, high-volume trades relative to the overnight liquidity, designed explicitly to create maximum downward momentum and panic selling. This is not genuine price discovery based on supply and demand fundamentals. This is market coercion. The players involved understand that many retail investors, and even some large funds, use stop-loss orders. By targeting these periods of low volume, they can efficiently trigger those stops, generating a waterfall effect that allows them to cover some of their previous paper shorts at much lower prices, thus resetting the stage for the next cycle of suppression. The profound implication of the true nighttime alert is that your diligence as a serious gold and silver investor must extend far beyond the narrow 9-to-5 trading window. We must watch the shadows, because that is precisely where the serious, controlling players operate. Do you truly grasp the sheer scale of the financial fraud we are discussing? It's not just a few mispriced contracts. It's the fundamental architecture of Western banking desperately trying to hold back the inevitable tide of economic reality and real value transfer. The longer they suppress the price, the greater the coiled spring effect becomes, ensuring that when the dam finally breaks, the resulting move will be proportionally violent. What does this nighttime alert mean for us practically? It signifies that we are rapidly nearing the inflection point where the COMEX's ability to provide registered, deliverable metal may fail. The open loop of when will the physical break the paper closes the moment a major institutional player, perhaps a large hedge fund, a sovereign wealth fund, or even another central bank, demands physical delivery of a substantial quantity of gold or silver, and the system cannot cough it up without raiding vaults intended for others. That moment will not be announced with a press conference. It will be a violent repricing event, almost certainly initiated by an explosive, uncontrollable move during one of those quiet overnight periods. The price will gap up dramatically, perhaps over a weekend or during Asian hours, fundamentally re-establishing real price discovery based on tangible scarcity, not based on leveraged, fictitious paper contracts. This breaking point, the climax of the alert, means two things. First, the paper price will be forced to converge with the physical reality, leading to exponential gains for those holding tangible metal and high-quality mining assets. Second, the volatility during that period will be unprecedented. We are not talking about a modest rally. We are talking about a systemic revaluation that could see gold and silver prices soar to levels that mainstream analysts currently dismiss as unthinkable. So, the fundamental warning stands. Prepare for the systemic volatility that is the inevitable fallout of decades of deliberate price suppression. Physical ownership and investment in the producers who pull the metal out of the ground is the only genuine shield. Do not be intimidated or distracted by the manufactured paper price smashdowns you see in the dead of night. Use that weakness. Leverage it. My advice is direct. Use these manufactured dips as gift opportunities. Secure your physical position now, and crucially, secure your position in the quality mining companies which offer operational leverage to the price of the underlying metals. Don't just observe the market. Understand the mechanism of the suppression and anticipate its inevitable failure. Make sure you hit subscribe right now and ring that notification bell. You absolutely must not miss part 2 of this alert, where I will detail the precise preparation steps you need to take and outline the specific sectors within the mining complex, from explorers to major producers, that I believe are set to explode the very moment this nighttime alert turns into the daytime reckoning we have all been waiting for. Stay diligent, stay focused, and understand that the current price is a lie waiting to be exposed by physical reality. We spent the better part of the last session analyzing the symptoms, looking at the erratic behavior of the paper market, specifically those aggressive low-volume dumps that happen when North America is sleeping. I want to be perfectly clear right now. Those aren't signs of market strength or bearish sentiment. They are the frantic flailing acts of a system in profound structural decline, desperately trying to paint a picture of stability where none exists. We are entering the final stage of this monetary cycle, the one I've been warning people about for decades. The paper facade is cracking, and the sound you're hearing in the pre-dawn hours is the sound of that foundation crumbling. Now let's turn our attention from the meaningless price quotes to the single most important metric in this entire market: physical availability. Forget what the talking heads on television are saying about interest rates or the latest Federal Reserve minutes. They are willfully ignorant of the core issue. The truth is not found in futures contracts, it is found in the vaults. The central conflict, the climax of this entire drama, rests on the simple fact that the traditional banking establishment and the paper exchanges, namely the COMEX and the LBMA, are running out of metal. I mean genuinely, catastrophically, running out of metal. Think about the COMEX silver inventories. We track the registered category obsessively, that metal designated as immediately available for delivery against a contract. For months we have watched this number flatline and then plummet to historic lows. When you have institutions drawing down hundreds of thousands, if not millions, of ounces a week, yet the registered total barely budges, it tells you something terrifying about the pipeline. It means there is no resupply mechanism functioning effectively, and the remaining metal is moving directly from the eligible category, metal sitting in the vault but not yet designated for immediate delivery, straight out the back door and into the hands of those who demand physical settlement. I cannot overstate the significance of this drainage. It is a slow-motion run on the bank. They are liquidating the last vestiges of readily available supply to meet contractual obligations that were never meant to be settled physically in the first place. The entire paper derivative market was built on the assumption of cash settlement and infinite leverage. They assumed no one would ever truly ask for the physical ounces. Well, now they are asking, and the answer is rapidly becoming, we don't have it. This leads me directly to why those nighttime raids are happening. Every time the price of gold or silver threatens to break a major technical level during normal business hours, or every time a major buyer steps into the market looking for significant physical tonnage, the paper manipulators hit the market with enormous short sales. But the volume behind these dumps is microscopic compared to what they used to be. They are deploying maximum psychological impact with minimum actual capital, because they know that if they push too hard and trigger real demand for physical metal, they will expose the fact that the inventory is dry. They are terrified of triggering a scramble for the exit doors. They are playing a game of chicken where the only car with brakes is the paper market itself. If you're listening to this and you haven't yet locked in your position, I urge you to hit that like button and subscribe to this channel immediately, because this information is designed to protect your wealth during the inevitable market reset. This is the critical juncture. Let's talk briefly about the gold-to-silver ratio. For years, I've argued that silver is the opportunity trade, the metal that will experience the most explosive move due to its dual nature. It's both a monetary metal and an irreplaceable industrial commodity, crucial for the green energy transition, solar panels, and electronics. The ratio currently sits at an absurd level, completely divorced from historical averages and far removed from the actual scarcity of silver supply relative to demand. Why does the high ratio persist? Because silver is the easier target to suppress. It's a shallower market, meaning the paper traders can push the price around much more effectively than they can with the multi-trillion-dollar gold market. But this suppression is precisely why the climax, when it arrives, will be so violent. Once the industrial users realize that the COMEX price is a complete fiction, and that they cannot acquire the physical inputs they need to run their businesses, once they are forced to bid based on actual necessity, the price of silver will decouple from gold and launch itself into orbit. We are talking about a ratio collapse that will define the greatest wealth transfer of our lifetimes. The core vulnerability they are trying to hide with their nighttime shenanigans is the simple mathematical impossibility of their situation. Annual global mine supply for both metals is static, if not declining due to years of underinvestment. Yet government and central bank debt is increasing exponentially. Physical demand from both sovereign entities and private investors who have lost faith in fiat currency is insatiable. The price of paper, gold, and silver must be suppressed to prevent the general public from realizing that dollars are being devalued at an alarming rate. But suppression doesn't create metal. It doesn't fill the vaults. And we have now reached the point where the supply is so restricted that any major physical demand event, a large ETF taking delivery, a significant nation-state diversifying its reserves, or a widespread industrial shortage, will snap the market. This is the big revelation, the closure of the loop. The nighttime drops are the death rattles of the paper market. They are designed to manage sentiment while the physical metal is secretly being drained. The game is almost over. The final stages of this paper manipulation require extreme volatility and intimidation to ensure that you, the individual investor, panic, sell your holdings just before the system implodes. They want your metal. They want your shares in the mining companies that hold the reserves. Do not give it to them. My strategy, and the definitive conclusion I offer you, is predicated on physical reality. You must own physical metal first and foremost. Then, you must own the highest quality developers and producers, the mining companies that have successfully navigated the decade-long bear market and are now sitting on verified, high-grade deposits that can be brought online. Remember, even when the price finally skyrockets, it takes 7 to 10 years to bring a new mine into production. The companies that are operational now or ready to transition to production now will provide leveraged returns that dwarf the movement in the physical metals alone. This is where the exponential wealth creation occurs. The systemic risk is no longer theoretical. It is tangible. Look at the sovereign wealth funds. Look at the central banks. They are accumulating physical gold at rates we haven't seen since the 1960s. Why? Because they know the debt burden is unsustainable. They know that when the credit system finally buckles under the weight of excessive leverage and unpayable liabilities, the only assets that will maintain purchasing power are those without counterparty risk. Gold and silver. The alert I issue tonight is simple and urgent. Do not be misled by the daily price fluctuations. Ignore the noise. Focus on the inventory numbers. Focus on the inability of the established system to deliver. When you see the registered category at the COMEX hitting 0, that is your definitive sign that the great repricing has begun. At that point, the paper price will become utterly irrelevant. It will cease to exist as a reliable marker of value, and true price discovery will finally occur, placing the value of these metals orders of magnitude higher than they are today. I implore you, check your allocation. Are you prepared for the volatility that will precede the breakout? Are you holding physical assets outside of the banking system? Are your mining equities focused on quality and jurisdiction? If you found this analysis insightful, please take a moment to hit the share button and forward this information to 3 other people you know who need to protect their savings. This is not about getting rich quick. This is about preserving the wealth you have worked hard to earn in an era of unprecedented monetary delusion. The storm is here. The midnight raids are signaling their desperation. Your opportunity to position yourself correctly is rapidly closing. Act decisively, focus on physical reality, and ignore the paper market lies. Secure your future. Thank you for listening. Make sure you subscribe and stay tuned for our next critical update on this developing financial crisis. Don't wait until the sun comes up and the price has already gone vertical. The time to act is now.